Good morning. Sorry for the late start. Oh, it's 1:15. Sorry. But I'm here. I'll wait for some more students to come in. Can you hear me? Good morning. Sorry. I'm watching the video at the same time. All right, so there's a test tomorrow, or it's going to start tomorrow and go until Monday, right? I'll give you until Monday to submit it. And it's going to include units 1 through 4. So I want to spend time on 4 today, but if you have any questions about the others, I guess I'll have you ask me at the end. So, are there any questions right now? I just wanted to go over the items that I didn't look at in detail last time. I'll wait for a few more people to see who shows up. Okay, so like 10 of you here. Okay, so this is what remains to we did discuss this in the notes before, but I guess repeat it here and give you an example. So this is how you deal with inflation. Remembering that if there is inflation, I'll indicate it, and if I want you to talk about inflation, or I want you to if I want you to extract or speak of the real rate of discount or interest, then I'll give you the information. Otherwise, assume that we're working with the nominal rates and nominal dollars always. And the rule is that you should take nominal cash flows and discount them with the nominal rate and real cash flows and discount them with the real rate. Where the real rate is determined by supply and demand in the capital markets and represents the opportunity cost, right? The nominal rate is adjusted for inflation, and they're treated like growth factors, so I multiply the factors. And I gave you an example where we applied this Fisher relation to solve problems both with nominal cash flows and with real cash flows, and I showed you if you use the nominal cash flows with the nominal rate in discounting or the real cash flows with the real rate, you should get the same answer in terms of present value or future value. And keeping in mind what is the discount rate, it'll be adjusted for higher risk cash flows. So it'll be a higher value. All right, so here's my example. Imagine you start with $2 million and you're looking at investment opportunities. You could invest in financial markets where there's a 4% rate of interest with no inflation. In that case, the nominal and the real rate are the same. Or you could invest in the Beverly Hills housing market, where currently the nominal rate of inflation is 4%. The nominal rate of discount or interest is 4%, and inflation is estimated at 5%, and it will be 5% for the next year. So should you, if you're interested in housing, should you purchase the home or not? So if you buy the house, your home value Okay, so let's start. If you don't buy, then you could invest in financial markets and accrue $2,080,000 at the end. So you'll get your $2 million plus $80,000. If you do buy the home, your home, because of inflation, the price of the home will go to $2,100,000. So you have another thing to think about here. If you invested over here in financial markets, you wouldn't have enough to buy a home if you wanted to the next year because inflation erodes the purchasing power of your money. So in conclusion, the real value of your money has depreciated if you're interested in purchasing a home next period. The best advice if you're looking into a home is to buy one and realize, the appreciation. You don't have to buy one in Beverly Hills, but this is just an example. If you had that kind of money, right? Because you do, $2 million. All right. So let's look at implications. Here's the Fisher relation. If I want to calculate the real rate with inflation at 5% and the nominal interest rate at 4%, the fact that it exceeds the nominal rate of interest implies that the real rate is a negative. The real rate of interest is a negative. Remembering this relationship between nominal and real cash flows, so for every year of inflation that transpires, to understand what And to understand the relationship between real that speaks of the purchasing power, you would have to adjust that amount for inflation. So after 1 year, of inflation, $2 million in real terms. So in other words, this represents, so what does this represent? This represents so that the purchasing power of buying a home today is retained. So that you can buy the same home or a similar home next period. So it, in real terms, $2 million in today terms would buy you a house. And if I write the expression this also has to be 2 million. In nominal terms, it means this is how much I need to be able to buy a house next period. So, if we are working with nominal dollars, then, and we pursued the purchase, we'd spend $2 million today, so that's our initial investment. And then next period, we would have the value in nominal terms of $2,100,000 in the home. Using the discount rate of 4%, because that's the nominal discount rate, it appears that NPV is positive. It's $19,230, explaining in another way that it's profitable to purchase the home now. You can get the same result, though, if you use real amounts. In real terms, it would be $2 million investment today, and in real dollars, next period, it's $2 million that the home would be valued at. Then using the real rate of discount that we computed, we get the same result. So this is a good example of how to use real rates with real dollars, nominal rate with nominal dollars, which rate is appropriate. So either way, you should invest. And then that's all I'm going to say about that. Any questions? So you guys should be able to step through this. It's just an exercise like the ones that we did before, and practice understanding what all these terms are. So what's really happened is there's inflation in the housing market, prices are rising, but not in the financial market. So you could take advantage and realize a payoff. Okay? Whether you look at it in nominal terms or in real terms. Then I talked about this capital budgeting exercise and we solved it together. We solved the case together last class. And the only thing remains to mention is just this discussion here. You were asked to take the total project cash flows. Remember, this is putting together the three parts, three sets of cash flows for income, investment, and tax shields and get a stream of cash flows like we had been working with until we got to this unit, and then evaluate those. And I asked you to calculate the IRR. So taking those total project cash flows, I ask you in the case to evaluate them using the nominal version and the real version. And it's really just to make a point that you can do that with the income cash flows and the investment cash flows. But when it comes to tax shields, we don't think of those in real terms. We think of them as a stream of nominal cash flows and distinguish them, okay? Anyway, it's just to have you realize you can do this whether in nominal or real, but you would have to separate out the tax shields. We get the same result anyway. So it's application of the Fisher relation. All right. So I've covered this case. All I wanted to do today was do a few cases together and then answer any questions that you might have. And that means I'm going to start I've given you the answers for all of these. Is there any particular one you want me to do? Does anyone have a preference? All right. A company with profitable ongoing operations is considering a major project. Let me know now, I'm going to get going on this one. The company has completed extensive research and development testing on a new product at a cost of $150,000. It is now considering whether to proceed with production or not. If the company goes ahead with the project, the company will be required to invest $600,000 in new steam and electric generation machinery. This equipment belongs to the asset class 00.4 and has a general depreciation schedule of 15 years. Okay, so we get to use a different schedule, and I've included the schedule here. So it's 15 years because equipment, steam and electric generation machinery depreciates slower than airplanes that we use 7 years for. So where do we start here? There's some other information below about revenues, expenses. It's a 5-year project. Then there's a salvage value here. We're going to sell the equipment, and we have to maintain working capital requirements at given levels. Then we're told about a labor shortage given the income tax rate and the cost of capital or the discount rate that we should be using. with the interpretation that if we didn't invest in this, we expect to invest in a project that gives a 10% rate of return. All right. So let's read through and identify the 3 sections, right? First, let's look for income. What goes into income? I'll use red for income. So this amount is for, well, this is already done, right? This is a sunk cost. So we're going to scratch that out and say sunk cost. We don't have to work with that. Then we're told about the investment in the equipment, but that's capital spending. That's not income. So I'm going to skip over all of this. So income in red would be and is that it? Okay, so revenues and expenses are income. And anything that has to do with costs. So there's something down here. An additional complication of the project is that it is expected to cause a labor shortage at the company's other plants. This will result in additional overtime costs estimated to be $20,000 per year for each of the 5 years of the project. So what does it mean? It means just that there will be a labor shortage, and so to incentivize hours of work, they'll have to offer overtime. So that's an additional wage. And they estimate that that's going to cost $20,000 per year for the next 5 years. Okay, so that's it. That's income in red. Let's put investment in blue. So investment will include the initial investment, it will include the sale, and this part, working capital cash flows. Okay. And finally, I'm going to work with tax shields. Tax shields, I'll put in green. So I need this information about 15 years. All of this goes into the tax shield, together with the tax rate and the discount rate are here. So are you ready? So some of you really like your accounting, and so you might want to do this in a table. I prefer to do this using the simplification formulas for annuities. That's how I'm going to do it. So you can try and confirm this if you like, making a table of values. So I'm trying to think of how to do this. So I will put them, I'll put the formula here, and then I'll transfer it all onto a single page. So I'm going to start with incremental revenues and expenses, the red. So I have revenues, expenses, and then this cost here. So this would be known as a side effect of the project. And it's obviously a negative thing. Oh, I'm gonna have to make this bigger, not smaller. Hold on. So PV income. Is equal to 300,000 for 5 years after expenses and I'm going to use the 10%, it's 10%, right? 10% discount rate. And it's a 5-year annuity. And then I'm going to add the labor shortage. Now let's look again what it says about the labor shortage. It says, oops, sorry, I'm making you dizzy. Labor shortage, it will result in additional overtime estimated to be $20,000 per year for each of the 5 years, okay? So I could actually put that in, right? So I could add that as a cost. So let me add that just in here. I'm writing it this way so you can see all the different pieces. So am I missing anything? Does anybody realize if I'm missing anything? What am I missing? I am missing something. Sofia, Eric, Sergio, Misael, Juan, Julio. Anyone? What did I miss? Aha. So I have the values here, but I haven't considered the after-tax value, right? This is just I'm going to make an income, but I have to pay taxes on the revenues, and then I'm using, I will expense these so that, or claim these amounts as cost, and then realized tax savings. So I've forgotten to put taxes in here. And the way that I do that, so I'll write this in a bracket and then say 1 minus TC in this case is 0.4, and then put the annuity adjustment here. Questions? So that will take care of it with the 1 minus 0.4, which ends up being 0.6. And this part ends up being 230. And then this ends up being, what's 230 times 0.6? I mean, you don't have to do all these intermediate steps. $138. So it's 10% because this is we're discounting cash flows. We're discounting cash flows in the amount of 138,000. Yes, thank you, Miss Isle. Okay, so stare at that for a moment and then punch it in your calculator and give me the answer. What do you get? Okay, we have people confirming the same answer. One more person to confirm. So you're going to store this amount. There's other decimal places as well. You can store it, I'm not sure what to say. So if you round this portion, you're not supposed to, but let's just say keep all the decimal places in store 1. So just store it all in store 1. One more person. Confirm my computation. Any questions about what we've included? One more person? No? Yep. People just watching. Make sure you make the calculations. It'll be much more meaningful if you punch it in. Okay. Thanks, nice Yvette. All right, so let's go to the next part. So to the next part. The next part is in blue, I said. Investment. So investment needs to include this initial investment, this salvage amount that we have to consider. We have to look at it against the book value, which we have to determine. And then that net working capital investment cash flows. So let's make a table. Okay, so now I'm going to use a table with the first 5 components here. So let me see. One second. All right, let's make a table. I'm going to write these figures down. So 5%, 9.5, 8.55, 7.7, 6.93. So those 5. And go to Excel. And remembering the elements of this table, first we have the principal amount, right? So the amount outstanding. And I refer to it as UCC. Now I know you have the answers, but it's really important to reproduce these yourself. So in the first column, I'm going to put D. D, small d, is a depreciation rate. In the second column, I'm going to calculate the depreciation amount in each year, which is equal to the amount of $600,000 multiplied by that number D. In the next column, I'm going to have the what's called the UCC, undepreciated cost of capital, which is calculated by the old UCC minus the depreciation amount. And then TC, what does the C stand for again? Multiplied by D, because this will calculate the tax shields for us. So those are the columns of my table. I can make it pretty. I already have too many. So the first one, you can put the years down too. So it's 1, 2, 3, 4, 5. I don't need these two. That didn't work. Once again, when I use Excel on my iPad, it's just slightly different. And I'm always baffled. Maybe it isn't different, but it just seems different. All right, so there we go. So I'm going to put the numbers in here. 5%. I'm going to enter as 0.05. And then 9.5. I did that wrong. 0.095. And then 0.0855. And then 0.0770. I'm not watching the comments right now. I'm going to go to that in a moment. And then 0.0693. So we'll do the first row and then we just copy down the rest. So right, one gave me 30,000, that's right. So I take the first one will be pad works funny here. So it's going to be equal this amount multiplied by 600,000. 1, 2, 3, 4, 5. And if you want, make sure the format is no, that's fine. I want to make the format this looks so different. I want to format dollars. Why can't I do it? Anyways, I should probably do this on my computer. I'm trying to put in the dollar format and I don't recognize the symbol to do it. Or maybe it's this one here. That'll do. Okay, and then we take 600,000 minus this amount to get the new amount, right? So this is the undepreciated cost of capital. That's what's left. So what I do next is I copy this all the way down to repeat the computation. And then in this column, I just keep subtracting. And that's it. So this amount is our book value. So let's see, I'll give you a moment to see if you can replicate that, and then we'll talk about what to do with it. So you can take this into your assignment, if you had an assignment, for your test, I guess. So you're going to take this, you can copy it. Well, once I finish the last column, I'll copy it over. Because I'll need this column here. You with me? So I need to take these amounts, this amount, and I have this amount. Okay, I'm going to work with that. It's this thing I'm talking about. So 75,000. This is what I'm interested in right now. This is what we're going to sell the equipment for. But what we've done is determined that the equipment at the end is worth $373,000. So if we sell it for this amount, what happens? What should we do? Okay, so what do we do? So we're going to claim a loss for that portion. All right? So let's put this together. I'm going to use blue. Don't forget that figure. So if we go back here, so you don't think I'm inventing something, I explained to you that this is the expression you should include So we need to include this expression for investment, this number, 75,000, and we're going to add this as well. So let's keep this aside for a moment. So this is going to help us because we're going to declare or claim a loss. We're going to take the book value minus the salvage value, and that will be an amount we can claim and earn tax savings. Okay? And let's do this piece here. Let's do this piece here. So let's take that. So here we have 50,000, 80,000, 80,000, 80,000, a bunch of 80,000s, and then 5. So how is this? How does this work into our calculations? I'm going to use a blue pen. That's right, Miss Hale. So we have 50,000. So we have, let's see, go to year 1. 0, 1, 2, 3, 4, 5. So 50,000 up front. You're going to need that to get started. Then 80,000. These were all given to you. And so by the end of the 5 years, you release these the value withheld in net working capital to the other projects of the firm or to the firm. So what does that mean in terms of changes? So up front we need 50,000. Then we need an additional 30,000, but nothing else. We're going to stay with 80,000 throughout the duration of the project, and then release back to the firm. Okay? So to calculate this, I just took 80,000 minus 50,000 to get the difference, and then 80,000 minus 80,000. All right. Now, what I really want are the investment cash flows. So we call this net working capital, investment cash flows. And that means because I need 50,000 for this project, it's an investment. I just changed the sign here. And I need an additional 30,000 for daily operations, but then I don't add anymore. So I have to replenish every time I fall short, maintaining always 30,000. 80,000 throughout. And at the end, I recover 80,000. Back to the firm. So from the firm perspective, these are the net working capital investment cash flows. So in investment, we have the initial investment. We have to add in the net working capital cash flows. Then we have to consider the present value of all of these, plus the present value of the salvage or the sale of the asset and any kind of tax savings that result, or taxes paid because you sold it for more. In this case, we sell it for less than it's worth. Okay, so let's see. Where should I put this? I'll take this whole thing with me. just so you remember what we did. That's there. It's kind of small, but it fits. So we need to put together this, and the initial investment. Okay. So the salvage was, we need to take the present value of this too, right? So we need the PV of all of this, because this happens in the 5th year. Okay. So that's we need the present value of that, we need the present value of this, and we need the investment. So let's make an equation so it looks pretty. So this last expression here, I need the investment. So initially, for net working capital, we set aside $50,000 for the operations of the project, right? So that's for current assets and current liabilities set aside, and they've already given you the numbers. But from the firm perspective, that's an investment. That's why I changed the sign here. So this needs to be a negative. If this one's a negative, then another, investment of $30,000, then that stays the same because we're only interested in incremental cash flows. And at the end, there's nothing. We don't need anything for this project, so we release the $80,000. That means the firm takes that $80,000 back. So you imagine the project as set aside from the other operations of the firm, and then it recovers these amounts. It's $80,000 worth of cash, inventory, whatever it is. Okay. So this line here is like the firm perspective: investment and then recovery. Okay, so this does look kind of messy, but all right, let's do this a little neater. So I'm going to make it a little neater. So I'm going to put this together now. I'm going to call this PV investment. This is my part 2, is equal to initial $600,000 as the initial investment plus the net working capital cash flows PV. So that would be, I'll put it in a different row. So that would be negative 50,000. And then this one discounted one period. And then just 80,000 at the end. Okay, so that's going to be added. And then we have the salvage effect. So then it's going to be plus In the 5th year, it was 75,000 plus 0.4. I'm running out of space. Let me do it again. So it'll be 75,000 salvage plus the fact that it's a loss earns tax savings. And then all of this is going to happen in the 5th year. So this gets divided by 1.1 to the 5. Sorry if it's messy, but in the notes you can follow. It's not so messy. So take some time and put that together and tell me what you get. So this is part 2. Income was part 1. So what do you get? Remember to refresh when it looks blurry. What'd you get? What'd you get? Okay, you got a number. Different numbers. Let's see who's right. Yes, it should be 506. Juan, double check. Check your results. So the answer should be equals 506 787 60, and then there's some more decimal places, so store it in 2 so you have it. This one you can put in Excel. You just have to put 3 zeros in here for 2, 3, and 4. What did I say? Excel. I meant you can put it into your financial calculator for NBV. All right, you ready for the third part? I'll give you some more time to punch that in. Okay, just to recap, this was the initial investment. This was the net working cash flows in present value terms. Net working capital investment cash flows in present value terms, and this is the result of the sale of the equipment, and the fact that we're going to claim loss in the sale and earn tax savings, all happening in the 5th year, so we need to discount. Very good. Very good. Felix, where'd you go wrong there? Double check. Verify. Oops. Verify. And we still have one more to go. So this took an hour. This took over an hour for us, didn't it? So you have to do it in parts, Sophia. You can do this, you can put it in Excel, or you can do it in parts on your calculator. So you put this into memory, and then you do this one with the NPV formula, and you do this one manually. You can simplify a little bit. You take this one, so this amount is 298,920. This one would be you just got to get organized in there. If I wanted to do that calculation for the networking capital, I can use NPV. So I need to clear this second clear work, and I enter 50,000, enter down, and then the first one is 30,000 negative, enter down, and I only have one of those. But then there's a 0. So 0, enter, down, and there's 3 zeros. Enter down, and then the last term is 80,000 positive. And then I ask for NPV, and I use a 10% enter down interest rate and compute. So this is the NPV portion, so 27,599. And this is the investment, the networking capital investment cash flows. So all of this So I suggest you figure out how you're going to do this in the neatest way. It's an investment, so it's negative. You can do it using Excel. You can use memory in your calculator. If you are writing the CFA exam, you're going to have to learn how to do this on your calculator, so might as well start. And of course you have the key, you have the clave, I gave it to you. So you can go step by step and see what I did there. So all that's left are the tax shields. So this is the amount for part 2. This was the amount for part 1. I never put the amount here, did I? We stored it. Let me take it from here. All right, so we have the red, which is income, the blue, which is investment, and the only thing that remains is the tax shields. All right, can I continue? It might take you some time if you haven't tried this yet. Take you some time to punch that in. Maybe you put a negative wrong somewhere. It's negative. Because you have the purchase, then you have net working capital, and then you have this amount, which is, I just calculated this, but the whole thing gives you negative 27. No, that's the one there. Where is it? What's this result here? So this result here is 120, 811, 42. You have to keep all the decimal places to get my answers. So you have 600 as the investment, and then an additional 27, and then you add back this, and you get 506. All right, so we're good? Okay, so practice. You guys have the clave, you can go through this. So I have those two terms, and the final step is to get the tax shields, which we have in the Excel table. We have to get them from the Excel table. So how do we calculate that? The formula is right here. I'm going to do it with TC 0.4 multiplied by D. All the way down. So take those amounts and so take the whole table at this point. Let's take the whole table and copy it. Oh, let's start here. And bring it with us to here. So you should present that to me as part 3. I use green. So for part 3, PUE tax shields is equal to 12,000 plus 22,800 plus 20,520 plus 18,480. So on your test, you have to write all this out. If you're going to use this method or you're going to make a table, you need to show me. I missed one. No. One. I missed one. Oh, because this is 1. Why do I always do that? 2, 3, 4, 5. Right? Because there's no depreciation until the end of the first year. Let me clean that up a bit. And what do you get? So use NPV in your calculator. Make sure you put a 0 for the first amount, right? I'll put a 0 here to remind you. So you should get 84,459.26. And this will be store 3. And then you add them all up. Try again, Isabeth. No, that's just the third part for tax shield. So you get $84,000 of tax savings. That's part 3. You have to add part 1, 2, and 3. Keep punching. Like I say, if you have this in Excel, use Excel. If you're using NPV in Excel, actually, yeah, you could use NPV in Excel because it does not include the first zero, the first cash flow initial investment. Ah, wait, you're right, I wrote the wrong number. Thank you. I pulled the wrong number out. If you put this together, you do get, you're right, 68,000, 11,8.3. Correcto. But the answer I gave you before was the final result of everything. So these are the tax shields. So in conclusion, NPV of the project is equal to recall 1 plus recall 2 plus recall 3, which is equal to 84,459.26, which is greater than 0, so accept the project. No, you're right, Nisabeth. You did it right. I wrote the wrong number. Sorry. I was writing the final result. So it's like a long process, but actually if you practice, it's very repetitive. We do the same thing every time. If you feel more organized using Excel, you can do that completely in Excel. But if you're going to hand that in to me, you have to send me, for the test, you have to send me the whole Excel sheet. So I can see your formulas that you've included. Okay, let's take a minute break. I have to check something. Take a couple of minutes. Remember to refresh your screen if it gets blurry. Refresh your feed. I'll take 5 minutes break. Okay, I'm back. The chapters for the test are chapters 1 through, I don't know. I think it's 1 through 6. Let me double check. Yeah, 1 through 6. So, chapters 1 through 6 in the text. And in my notes, units 1 to 4 in the notes. Yeah. All right, so what do we do next? Should we do another one? So which one should we do? You tell me. There's quite a few. Which one should we do? So much noise. I don't know if you guys can hear. There's so much noise around me. I gotta figure out that noise. All right. All right. So let's look at this one. So read through it if you hadn't had a chance, and identify what's income, investment, and tax shield info. Okay, ready? All right, I'm going to read through and pull out income first. In red. First noting this is sunk cost here, so don't worry about that. Jorge Munoz, owner of Trujillo Pan American Technologies, is pursuing a special project related to the use of cable television technology for internet access. He has already invested $1 million into research and development, so that's sunk costs. It's done. If he chooses to do the project, that money's already lost anyway, so it's not incremental. Connected with design and production of new black blocks, It's a 4-year project. 4-year project. Keep that in mind. Next. To put this project into full-scale production, it will have to invest $3 million in production equipment. So investment, I will put in blue. But expects to be able to sell in 4 years for $500,000. So that's also part of investment. This new machinery could be depreciated. This is all investment information using a maker's table, 5-year schedule. Alternatively, it could lease the equipment for $50,000 per month, paid at the beginning of every month. So this is, so if they invest, this will be included investment, but if they lease, this will be included as a cost, just making that point. So leasing, this would be red for income. They also have to pay $100,000 safety deposit, so this would be for the lease, and it will be returned if the equipment is returned undamaged. Okay, and leasing is tax deductible. Very good. Okay, so that's what's going to happen. Next, pre-tax revenue. So this is red. This is income for 4 years, and expenses $500,000. And these are the investment capital, net working capital requirements, which I also put in blue. And then labor cost increased shortage, so that will go into income. Okay, so that'll be indefinitely. That's not just for the 4 years of the project. This is the tax rate, and that's it. So the question is, should you lease or buy the equipment? So I didn't mark the tax shields. The tax shields would come if you bought it, but not if you didn't buy it and you leased it. So since the revenues and expenses and net working capital will all be the same, and labor costs, this will all be the same whether or not you buy the equipment, whether you lease it instead. This will all be the same. So all we really need to do for our analysis is compare the relative costs here of buying and leasing. I believe that is the correct approach. What do you think of that? So this is not as well, it depends. Wait a second. What did I do here? I'm just looking. I have some questions. What did I ask? Okay, so I asked you to do the entire analysis. I asked you to get the NPV. Okay, so I need you to get the whole thing, but then in the end, the decision will be based on the cost of buying versus leasing. All right. So we begin with okay, so it says evaluate the impact. All right, so I'm just going to look for the impact of the NPV. I don't have to get the whole NPV, right? The way that it's worded. What is the impact of the purchase and resale? And it tells you everything to include. So we go for the $3 million. So everything I underlined as income will not be important. We're just going to work with this $3 million and the impact it has on NPV. So what I'm going to do is go right to Excel. Oh, let me borrow this heading. And I'm going to get the 15-year schedule, a 5-year schedule from the makers table. So I have to go to the makers and grab I get my makers table. And we need the 5-year schedule. So I'm going to take, and I only want 4. And I'm further given instructions to round to 2 decimal places. Right? Oh, 5-year schedule? No, it's 4-year project, right? So those are the amounts. After we copy them, but I just want to follow along here. So this is 0.2 and 0.32 and 0.19 and 0.12 if I do 2 decimal places like it says. Okay, and then I need to change this to 3 million. Those are the amounts. And if I want to make them dollar figures, how did I do that again? Oh, I hit this one. Okay. And now I'm going to account for 1, 2, 3, 4, 5, 6. I'm going to account for the depreciation in each year. I did something wrong here. This is not right. I need to go and put this number in. So I want to subtract the depreciation amount each time off what remains. So this is the book value. Let's get the tax shields and then be done with this, and I'll bring this over to the analysis, right? So the tax shields would be the tax rate, which is 0.4, multiplied by D each time. So let's take this whole thing over. Actually, let me make this a different color like I did last time. Okay. Questions? You're just watching me, or are you trying? I hope you can sit and try this. So I'm copying. Did I already say copy? And that is my table. So, how do I put that together now? Let's put that on a different page. So the impact of this on the NPV will be through investment and tax shields, right? So it's going to affect investment, because it will be $3 million invested, and then this is going to be sold for how much? $500,000 at the end, and we see that it's slightly worth more than that, so we're going to claim a loss, and we do that by doing PV of salvage, right? That formula, plus TC book value minus salvage. Because if the book value is more and salvage is insufficient, you get tax savings, so this is a positive. So that's going to be totaling the present value. All of that happens in the fourth year. So in the fourth year, what is the discount rate? Sorry, I have to go back. Discount rate is 15%. Okay, so be careful with that, with the discount rates, because they change and the years change, and so that'll be different. So the salvage is 500,000, and then the tax rate is I have to double check, 0.4. Yep. And then book value is 510, and salvage is 500. I don't know why I'm typing this again. I'm just going to simplify up here. Let me move this over. Move this down. All right, so you're with me? Did I miss anything? So that is the effect on investment, 3 million spent, and then this amount. Did I miss anything else? So this is the impact, whether or not we buy or lease, the net working capital investment cash flows are the same, so I don't have to include those. The only other thing is the tax shield. So I'm going to tell you that this turns out to be, well, this amount is $288,163, so you can verify that, 0.64, and store that. And then add it, oh actually no, we shouldn't store it because we still have to add it. So add it to 3 million negative. Let me get rid of this. It's so loud. So subtract 3 million from it. In other words, and there's also going to be an impact on present value of tax shields. And all we have to do is take these amounts, 240, 384, 228, and 144. Now you could do that easily in Excel. If I go back to Excel, I could just do that here and get the amount myself by saying and discounting this amount. I don't think I have to put a bracket there. I think it knows. And then here you want it to be a 3. And here you want it to be 4. And then you want to sum. Is that right? Yeah. So I can actually take this whole thing over for myself. Well, the formula, that just be, I call this present value. So I've calculated the present value for each case for each year and get this amount in the end. All right, so that would be the value here. 731,300.99. You can keep the decimal places. So you would have to add this to this amount. Yeah. So this is the effect. So this is like the impact on present value of investment. This would be the impact on present value of tax shield. And so total of buying is the present value of the fixed asset purchase, or the initial investment in equipment capital, plus the present value of the tax shield, plus the present value of the salvage. Actually, what I just called it was, oh well, whatever, because that's the fixed asset, tax shield, salvage. I'm going to put salvage first. Tax shield. And you get, when you put it all together, it's going to cost $1,980,535.37. So buying the equipment earns you tax savings, so that offsets the cost. Also, you can sell it later and claim a loss, and that gives you something too. So although it's $3 million today, it's offset. So it's really almost $2 million, not $3 million. It's very important to remember that. Think about the tax treatment, and there's incentives here. Clearly there's an incentive to invest in this business. The government has created the tax code so that there's incentive for business here. Buying that equipment, using it and for your business saves you $1 million. Now the other piece was to actually lease. So for leasing, so you guys can take a screenshot and I'll go back to the question. So all this you can present to me in Excel, but you have to give it to me with the formula so I can see how you've set it up. I'm going to erase this one. All right, so let's see the leasing option. Leasing. $500,000 a month is the price of the cost of leasing. And then it's $100,000 at the beginning, and you get your money back, and we'll assume that the equipment wasn't damaged. But the lease payments are tax deductible, so we're going to include that as well. Should I let you try that without me? Oh, it's already 11:42, so let me just show you the answer so we can get going. So we have a lease. We have to pay a safety deposit, but get the money back in 4 years. And because of the time value of money, we will get less than $100,000 back in present value terms. So we need to discount that amount. The first is a negative because we pay that, then we get this back. And all of this is tax deductible. So this is the amount. So notice I have it tax deductible. So this is after tax amount for the for both the safety deposit is tax deductible, and so then you get to claim the loss or the cost as an expense, and then here you have to actually pay taxes on the fact that you're getting $100,000. That's how I've set it up. Then for the lease, it's a monthly lease, so I need the monthly rate. I set it up as an annuity, keeping in mind that that's also tax deductible, so it's not as bad as it looks. And when you put all of that together, you find that this is, assuming there's no damage to the equipment, so you get the money back from the deposit. The lease option costs you $1,135,000. So in the end, the lease option is better because it just costs less. All right. So the tricks here, or the catch, is just that I use an after-tax amount here, and just don't forget that the lease payments are tax deductible, so you have the after-tax amount here. Changing that to the monthly rate also is important for the lease payment. Oh, and the other catch is that this is an annuity due because it's at the beginning of the month, so I have to use the annuity due formula, which is an upfront payment, and that leaves 47 rather than 48 payments because 12 times 4 is 48, but the first one happens immediately. That leaves 47. So you guys should practice punching that in. That would be in begin mode in your calculator with 48 payments. That will give you the answer for that. So as menacing as it looks, the answer is quite short. So I'm going to post the test tomorrow. It will have one capital budgeting exercise on it, and the rest will cover units 1, 2, 3. Okay, so I'm giving you until the end of Monday to complete the test. Please let me know if you have any questions today, or even when you're writing the test, if something's confusing, let me know. Okay. Any questions right now? No questions? All right, so keep in touch. You can text me. I appreciate you attending. It creates, at least for the people who aren't here, they are able to watch the dialogue and see how you're answering things and see your questions, and you're also helping catch me when I'm making mistakes. It's much better live stream for me than me editing these videos and making mistakes and having to correct them and go back. So anyway, it's much more efficient for me. I really appreciate your participation, and I hope you enjoy or appreciate the test, that it's not overwhelming, and that you learn something. But you do have all the tools you need. You just have to rehearse, practice with the questions I've given you. And if you want, you can meet with me. We can have a session where you can show me or ask me where you're having trouble. You can also text me. You can take a screenshot, or take a picture of what your work if you're stuck, and let me know what your questions are. Or even when you're reading through the solutions, if there's something that surprises you, just like this, and you want a clarification, I'll give it. So with that, I'm going to say, have a wonderful weekend. I don't expect you to spend the whole weekend writing the test. The test should only take you, let's say 3 hours. It should only take you 3 hours, but it might take you 5 hours. It might take you 6, but don't spend the whole weekend on it unless you really need the weekend to study this material because you haven't had a chance. That's my best advice for you. Okay? So take care. Cuídense. We will be in touch. Bye.